Hey there, Jared Hamilton with the Hamilton Group of Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Hope you guys are doing great. Hope you're getting ready for the holidays. Real estate market's really busy. Holidays approaching. That means we all got tons of stuff to do. Stay calm and it'll all get worked out. It'll be great holiday season. And the great news is the real estate market is doing good. But I wanted to get with you here to let you know what happened with interest rates and most importantly, what happened with the FOMC meeting, so I can tell you what in the FOMC happened. So here's what went on with interest rates this week. Now, rates finished the week worse than they ended last week, and that was due to the FOMC kind of surprise, which I'll get to in a second. But throughout the week, here's what's going on. In Europe, it's still a mess. Good news is Greece did not default on a huge debt that they had to repay. So the good news is they didn't default, and so they dodged a bullet, but still Spain and Italy are a mess, and so Europe is still kind of a mess. But Greece didn't default, so that's good. Freddie Mac came out with their national housing survey. Here's what they said. They said that it is their prediction that interest rates will remain amongst record levels in the first half of 2013. They will start increasing in the second half of 2013, but it's their prediction that they will still remain below 4%. So that's what Freddie Mac is predicting. Also, they're predicting that the national housing appreciation rate might be around 3%, with some areas experiencing even higher gains. But again, who knows if they're right? That's just what they're predicting. So there you go. Retail sales came in at 0, so pretty anemic. Now, actually, if you include autos, it increased 0.3%. Excluding autos, it was big old donut. So that didn't really show any super positive things, which is good for interest rates, especially in the holiday season. It would be great for the economy to show high retail sales numbers, but it's just flat. Producer Price Index, which measures inflation at the wholesale level, was also a big old goose egg. That was 0. And that's well below the Fed's target rate of inflation at 2%. So low inflation, and that's good for interest rates. But here's what happened on Wednesday. Federal Reserve met, and they released the notes of the meeting. And they made a little bit of a big departure from what they normally do. Here's what they said. Operation Twist is ending. So the market wanted to find out what the Fed's going to do. Now, what Operation Twist is that the Fed was selling short-term treasuries in their portfolio and taking that money and buying long-term treasuries to try to keep interest rates low. Well, that's ending, and so they just said that they're going to buy an additional $40 billion per month of long-term treasuries, in addition, or $45 billion, in addition to the $40 billion of mortgage-backed securities that said that they would buy per month. So it's $85 billion of bonds and mortgage-backed securities that they'll be buying every single month. And so they're doing that to try to keep rates low. That wasn't a huge surprise. The big surprise is that they're going to tie the Fed funds and the discount rate and increasing those to unemployment. So as long as unemployment is above 6.5%, they're going to maintain their accommodative stance, which is keeping short-term rates between 0 and 0.25%. So that's the first time that the Federal Reserve has ever tied it to an economic number. And what made the market a little bit nervous is that, well, one, they don't know how to necessarily evaluate this, and so mortgage-backed securities got worse. Second thing is that everybody knows these unemployment numbers are just kind of whacked out anyway. They're not super reliable. And what happens if a bunch of people quit working, so they go off the unemployment rolls, and then we know that they're not counted in the unemployment numbers. So is it artificially decreasing the employment rate? So the Fed did say, though, too, that they were going to need to make sure that inflation was under control, and other economic conditions didn't warrant increasing the Fed funds and discount rate. But generally speaking, they tied it to something, and that caused a bit of a sell-off. I don't think it's going to be a major trend. It just is what it is. The bottom line is, and the Fed confirmed this, is that economic picture here globally or nationally still pretty anemic. We've seen some positive things, but it is still below what the market or what the Fed wants to see. Inflation is really low, and globally things are still pretty bad. So we'll see rates remain super low. We will see some volatility going into the holidays here as traders have short-timers disease leave and, enjoy the holidays. And because there's less people trading, that can cause some volatility, but it's probably not any major trends. And for that reason, I'll be keeping you up to date with what's going on economically, but maybe over the next couple of Java with Jareds, towards the end of the year, we'll just talk about how to make 2013 your best year ever, okay? Hope you guys are doing great. Thanks again for joining me with Java with Jared. As always, if you have any questions, give me a call. We'll talk to you soon, and enjoy getting ready for the holidays, all right? Bye-bye.